Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 2, and this is Section B1. This is a remembering and understanding topic. Understand supply and demand, elasticity measures, and profit maximization, and that would include things like marginal cost and marginal revenue. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. Again, it's free. It's 1 hour, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time. So again, check out the webinar, and after you watch the webinar, you're going to want to learn more, so make sure you check out becoming a pro member of SuperfastCPA. SuperfastCPA pro members get access to the full 10-question versions of these videos. So just to clarify, in this video, we're only going to be going over 5 questions to learn a little bit about this topic, but SuperfastCPA pro members will get access to the full 10-question video when we post it in the forum, so they can get a little bit more practice and a little bit more understanding. So if you like this and you like our other videos, make sure you check out becoming a pro member of SuperfastCPA, because again, you'll get access to the full videos and you'll get a little bit more practice and a little bit more understanding, just like the rest of the pro members. So one last time, check out the webinar, check out becoming a pro member, and with all that, let's dive straight into the questions for this video. All right, here we are at question 1. Now, one thing I want to say about this video, this feels like a topic that should be in FAR or BAR or something like that, but it is a topic in the blueprints for audit, so that's why we're going over it. We're going to learn about kind of 3 different topics. So these questions might be a little bit large occasionally, just because I'm trying to explain a lot about these things in just 5 questions. So make sure you take lots of notes, make sure you understand what we're talking about. So anyway, let's dive into question 1. Which of the following best describes the law of supply? Okay, let's walk through these options. Option A, as the price of a good increases, the quantity supplied decreases. Option B, as the price of a good decreases, the quantity supplied increases. Option C, as the price of a good increases, the quantity supplied increases. Or option D, there is no relationship between price and quantity supplied. Okay, so if you have any knowledge of supply and demand, microeconomics or just economics in general, then you might know what this is. You might know what the law of supply is. If you don't, that's okay. We are going to use these questions to learn about all of these different things. So if you want, maybe pause the video to think through this. If not, let's go ahead and look at the answer together. All right, here we are at the answer C. As the price of a good increases, the quantity supplied increases. Okay, let's walk through this. Again, this is kind of a large explanation because there's a lot that we can understand here. And, understanding supply and demand is kind of a broad topic. So I wanted to make sure that you understood different parts of it as we go through these questions. So let's walk through the explanation. The law of supply states that producers, so the people making the supply, are willing to supply more of a good or service as its price increases, assuming all other factors remain constant. Higher prices create an incentive for suppliers to increase production to maximize revenue. So again, from the producer standpoint, if the price goes up, then that means that supply is going to go up because they want to make more money. However, it's important to distinguish between a change in quantity supplied and a change in supply. Those are 2 different things, and I want to make sure that it's very clear. A change in quantity supplied occurs only due to a change in the price of the good itself, causing a movement along the supply curve. And if you want to look at a supply curve or a demand curve or things like that, just look it up on Google or whatever. You'll be able to see it, or maybe even in your textbook, you'll be able to kind of see that curve and understand what I'm talking about. But again, a change in quantity supplied just moves along the curve, whereas a change in supply means the entire supply curve shifts left or right due to factors other than price. The entire curve moves instead of just moving along the curve. This happens when something alters the conditions of production, affecting how much suppliers can produce at all price levels. And this next big paragraph is going to just kind of talk about some of the things that can cause supply to shift. So again, several factors can cause supply to shift. Input costs play a major role. When the cost of raw materials, labor, or other inputs rises, supply decreases because production becomes more expensive, while lower costs increases supply. Technology improvements make production more efficient, reducing costs and increasing supply. The number of suppliers in a market also matters. More firms increases supply, while fewer firms reduces it. Government policies such as taxes, subsidies, and regulations can either discourage or encourage production, affecting supply accordingly. Finally, producer expectations about future prices influence supply decisions. If prices are expected to rise, firms may hold back supply to sell later, while expectations of lower prices can lead to increased supply now. So again, we learned about the law of supply when it comes to supply and demand. So we're just talking about supply in this question. There's a lot to this. Again, we talked about multiple different things. Make sure you understand these differences, and then let's go to the next question. All right, here we are at question 2. What does the law of demand state? So let's walk through these options. Option A, as the price of a good increases, the quantity demanded increases. Option B, as the price of a good decreases, the quantity demanded decreases. Option C, as the price of a good increases, the quantity demanded decreases. Or D, demand remains unchanged regardless of price. Now, based off the first question, you can probably guess that D is incorrect, but what's the relationship between demand and price compared to supply and price? If you have an idea, that's great. If you don't know, maybe pause the video and think through this, and when you're ready to come back, we'll look at the answer together. Okay, here we are at the answer. C, as the price of good increases, the quantity demanded decreases. And, again, this is kind of a larger explanation because there's a lot to demand. There's a lot about demand that you might need to know. So let's walk through this big explanation. The law of demand states that as the price of a good increases, consumers tend to buy less of it. And, that of course makes sense. We all experience that in day-to-day life. And as the price decreases, consumers tend to buy more, assuming all other factors remain constant. This inverse relationship between price and quantity demanded is a fundamental principle of economics. However, just like before, it's important to distinguish between a change in quantity demanded and a change in demand. A change in quantity demanded occurs only due to a change in price, just like a change in quantity supplied, of the good itself, causing movement along the demand curve. A change in demand means the entire demand curve shifts left or right due to factors other than price, affecting how much consumers want at all price levels. Let's walk through those factors. Several factors can shift the demand curve. Consumer income affects demand. Higher incomes increases demand for normal goods, while reducing demand for inferior goods. Preferences and trends also play a role, as popular products see increased demand, while those falling out of favor see demand decline. The prices of related goods matter too. When the price of a substitute rises, demand for its alternative increases, while a price increase for a complementary good reduces demand for the related product. And you can kind of think about what those words mean. Substitute, something that you buy instead of the other product. Complementary good, something that you buy with the other product because they go so well together. Consumer expectations influence demand as well. If people expect prices to rise, they buy more now, while expectations of lower prices lead to delayed purchases. Lastly, the number of buyers in a market affects demand. More buyers increases demand, while fewer buyers decreases it. And again, I think demand makes a little bit more sense than supply, just because that's what we deal with personally each day. But now we've talked about supply and demand in depth. Now let's go to the next question. All right, here we are at question 3. Which of the following best describes price elasticity of demand? So let's walk through this. This is a new topic. Option A, it measures how sensitive consumers are to price changes. Option B, it determines how much it costs to produce a good. Option C, it shows how supply changes in response to consumer preferences. Or option D, it measures the total revenue a company can earn from a product. So we're talking about price elasticity of demand. If you don't know what that is, if you've never heard that before, that's okay. We're going to use the explanation to learn about this. But if you know what that is or kind of roughly understand it, maybe pause the video and think through this. And when you're ready, come back. We'll look at the answer together. All right, here we are at the answer. A, it measures how sensitive consumers are to price changes. That's kind of like a very general understanding of price elasticity of demand. This is a little bit simpler of an explanation, so it won't take too much time. Price elasticity of demand measures how much the quantity demanded of a good changes in response to a change in price. Some products have elastic demand, meaning that when the price increases, consumers quickly reduce their purchases. And that would be things like luxury goods, non-essential items. Other products have inelastic demand, meaning that price changes have little effect on quantity demanded. That would be things like essentials, like gasoline or medication. So just to make sure that it's clear, we're talking about elasticity right here and how elasticity is applied to demand. Something being elastic means that it changes in accordance with price. If something is inelastic, it doesn't really change even if the price changes. So again, just to make sure that's clear, when a good is elastic, the demand for it will change a lot with price. If a good is inelastic, the demand for it will pretty much stay the same even if the price changes because people have to buy it. And I'm sure you can think of a lot of different examples, more than what we wrote here, but again, elastic, kind of think of luxury goods, non-essential items when it comes to demand. Inelastic would be things like, again, essential goods like gasoline or medication, and you can think of some more yourself. Now with all that, we've learned a little bit about price elasticity of demand. Now let's go to the next question. All right, here we are at question 4. Which of the following best describes price elasticity of supply? Okay, so we learned a lot about elasticity in the previous question, but now we're talking about supply instead of demand. Let's walk through the options. Option A, it measures how much the quantity supplied of a good changes in response to a price change. Option B, it measures how much the quantity demanded of a good changes in response to a price change. Option C, it shows the relationship between production costs and consumer demand. Or option D, it determines how much revenue a company will earn at different price levels. Okay, again, based off the previous question, I bet you already know the answer to this because I think one or two of those are obviously wrong. But if you don't, that's okay. pause the video, read through these on your own, and when you're ready, come back, we'll look at the answer together. All right, here we are at the answer. A, it measures how much the quantity supplied of a good changes in response to a price change. So again, that one probably should have been pretty clear based off the previous question. Let's talk about the explanation. Price elasticity of supply measures how responsive producers are to changes in the price of a good. If supply is elastic, producers can quickly increase output when prices rise, such as manufactured goods with readily available materials. If supply is inelastic, producers struggle to adjust supply quickly in response to price changes, and that would be things like agricultural products that take a lot of time to grow. So it's a little bit different when it comes to elasticity of supply compared to elasticity of demand. When it comes to supply, elasticity is a little bit more about how well can the producers make the supply based on the change in price. Remember, when it comes to supply, if the price is going up, they actually want to produce more. So they want to quickly produce more so they can get more money. And same thing with the price goes down. If the price goes down, they are not wanting to produce as much, so they're not going to manufacture it as quickly. But when the price goes up and they are inelastic, they aren't able to catch up with the supply as quickly. And so again, that kind of means why it's inelastic. Now with that, we've talked about price elasticity of supply now. Now let's go to the next question. Okay, here we are at question 5. How does a company determine the profit maximizing level of production? So again, kind of another topic. Remember, this blueprint topic has like 3 different things we needed to talk about. Now we're talking about profit maximizing production. Let's walk through these options. Option A, by producing until total revenue equals total cost. Option B, by producing until marginal revenue equals marginal cost. Option C, by minimizing production costs as much as possible. Or option D, by maximizing the cost of its products. Okay, so again, profit maximizing. I bet that if you just kind of pause this and think through these different options, you will definitely see that 1 or 2 of them are more obviously correct than the others. That happens all the time with audit. If you want, pause the video, think through this, and when you're ready to come back, we'll look at the answer together. Okay, here we are. The answer is B, by producing until marginal revenue equals marginal cost. So let's talk about those and their relation to profit maximization. A company maximizes profit by producing up to the point where marginal revenue, and that's MR, equals marginal cost, and that was MC. So marginal revenue is the additional revenue earned from selling 1 more unit of a product. Marginal cost is the additional cost incurred from producing 1 more unit. So if marginal revenue is greater than marginal cost, the company should increase production, since each additional unit brings in more revenue than it costs to produce. If marginal revenue is less than marginal cost, the company should reduce production, since producing more would result in higher costs than revenue. That makes sense. If it's costing you more money when you make something than the money you're actually getting from selling it, you shouldn't keep producing it. Now, when we talk about profit maximization, we're talking about when marginal revenue equals marginal cost. So you want to keep producing until the marginal revenue equals the marginal cost, meaning the company has found the most efficient level of production. And again, you want to get to that point because you're making more and more money all the way up until that point. And once you've reached that point, you're not making any additional money by producing more. So again, you want to produce more and more until you reach marginal revenue equaling marginal cost. If you have marginal revenue that's greater than marginal cost, you want to keep producing until, again, you get to marginal revenue equaling marginal cost. And that is profit maximization in a nutshell. And we've talked again about 3 different subjects, essentially. We've talked about supply and demand. We've talked about price elasticity of supply and demand. And now we've talked about profit maximization. So with that, before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2, 3, 4 questions trying to teach you about profit maximization, or you've seen 2 or 3 questions trying to teach you about elasticity, or whatever the case is. You notice these things as you're going through the questions, and so you take a moment, in your own words, you write out the pillar topics that you just learned. And as you're doing this each day, you're building your own personal repository of the most important things you need to know for the exam based on the questions you practiced in your own words. And that will help you prepare for test day. Now with that, let's go to the pillar topics for this video. Okay, here we are at the pillar topics. Let's just go through each of them. Law of supply and law of demand. The law of supply states that as the price of a good increases, the quantity supplied increases, while the law of demand states that as the price of a good increases, the quantity demanded decreases. And for each of those, you can do the reverse. If with the law of supply, if the price of the good decreases, the quantity supplied decreases. With the law of demand, if the price decreases, the quantity demanded increases. They have a direct and then an inverse relationship, respectively. Now let's talk about the difference between a change in quantity supplied or demanded versus a change in supply or demand. A change in quantity supplied or demanded is caused only by a change in the goods price and results in movement along the curve, while a change in supply or demand is caused by factors other than price, and that would be things like technology, income, substitutes, and it results in a shift of the whole curve. So remember, when you have a change in quantity supplied or demanded, that's when you just move along the curve. But if you have a whole change in the demand or a whole change in the supply, then that's a shift of the entire curve. Now let's talk about price elasticity of demand and supply. Price elasticity of demand measures how much consumer demand changes in response to price changes. Luxury goods tend to be elastic, while necessities are inelastic. Price elasticity of supply measures how much producers can adjust supply in response to price changes. Goods that are quick to produce are elastic, while goods requiring long production times can be inelastic. Now let's talk about the factors that affect elasticity. Demand is more elastic when substitutes are available, the good is a luxury, or consumers have time to adjust. Supply is more elastic when producers can quickly increase output, have flexible resources, or store inventory. And, kind of the reverse of each of those points would cause demand to be less elastic. And now to finish off, let's talk about profit maximization. Again, that was when marginal revenue equals marginal cost. A business maximizes profit by producing until marginal revenue equals marginal cost. This means producing more when marginal revenue is greater than marginal cost and stopping when marginal revenue equals marginal cost. Since producing beyond this point leads to losses as the cost of making additional items exceeds the revenue they bring in. And that makes sense. If your marginal cost is greater than your marginal revenue, you're losing money by producing more items because you're not making as much revenue as it is costing you to make the items. Now, with all that, again, we've talked about a lot in this video. We've talked about supply and demand. We've talked about elasticity, and we've talked about profit maximization. And that is it for this video. Remember that we only went over 5 questions, but SuperfastCPA CPA Pro members will be able to access the full 10-question version of this video, and I'm about to finish recording that right after I finish this. So if you like this and you like our other products, make sure you check out becoming a Pro member so you can get access to those full 10-question versions of the videos. And the easiest way to become a Pro member is by first going to SuperfastCPA.com and signing up for our free 1-hour webinar training. After you watch that 1-hour webinar training, you will understand a lot more and you'll be able to know how you can become a Pro member much more easily. So again, check out the webinar. That will help you become a Pro member, and Pro members get access to the full versions of these videos. Now, before you go, if you liked the video, make sure to like it and leave a comment. I hope this video was helpful, and I will see you in the next video.